How does settlement work for standardized options? Have you ever wondered what happens when you exercise an options contract? Understanding settlement is key to navigating the world of options trading. Settlement for standardized options is the process of fulfilling the terms of the contract when it is exercised or expires. These contracts give the holder the right, but not the obligation, to buy or sell a specific underlying asset, usually 100 shares of a stock, at a predetermined price before or at expiration. The settlement process varies based on whether the option is exercised or expires. When an option holder decides to exercise their right, the clearing organization steps in to facilitate the settlement between the buyer, known as the holder, and the seller, referred to as the writer. For equity options, exercising typically results in the physical delivery of the underlying shares. For example, if you exercise a call option, you buy 100 shares of the stock at the strike price. Conversely, exercising a put option means you sell 100 shares at the strike price. The delivery of shares usually occurs on the next business day after the exercise, which is known as T+1 settlement. This means the stock changes hands and payment is made one business day after the exercise notice is processed. Options also have standardized expiration dates, which are typically on the third Friday of the expiration month. If an option is in the money at expiration, it is usually exercised automatically by the brokerage unless the holder instructs otherwise. If an option is out of the money, it expires worthless, and no settlement occurs. The option simply disappears from the account. Some options, like index options or certain binary options, are settled in cash rather than through physical delivery. When these options are exercised or expire, the holder receives a cash payment equal to the difference between the option's strike price and the settlement value of the underlying index or asset. For binary options, the cash settlement is a fixed amount if the option finishes in the money, regardless of how much it is in the money. The settlement cycle for securities in the United States has been shortened to T+1. This means that once an option is exercised, the underlying shares or cash payment must be delivered and settled by the next business day. This faster settlement cycle reduces counterparty risk and improves market efficiency. Brokers play a significant role in this process. They often automatically exercise into money options at expiration unless instructed otherwise by the client. If an option holder wants to avoid automatic exercise, they must close the position before expiration. Some brokers may charge fees if options are exercised or assigned automatically. In summary, settlement for standardized options involves either the physical delivery of the underlying shares or a cash payment, depending on the type of option. The process is governed by standardized expiration dates and settlement cycles, with most equity options settling on a T+1 basis after exercise. Automatic exercise of in-the-money options at expiration is common unless the holder takes action to close or waive exercise. This system ensures that the rights and obligations of both parties in an options contract are fulfilled in a timely and organized manner.